As Benjamin Franklin said, there are only two certainties in life, and today I'm not here to talk about death. If you're like most people I know, you're probably frustrated with our tax system. Whether you feel that your taxes are too high or irritated that our federal, state, and local governments waste tax dollars, trust me, you're not alone. I remember a comedian mentioning one time that he was reviewing his paycheck and noticed a lot of his tax dollars going to some guy named FICA and proceeded to give the great punchline, "I don't even know this guy." Well, anyway, let's talk about taxes. Income taxes, to be specific. If you earn a paycheck, you likely pay income tax. But if you're like many people, the how and the why behind the annual 1040 forms remains a mystery to be solved only by their accountants every year. Today I'm going to take a look at what exactly is income tax and how it works. Hi, my name is John Gigliello, and you're listening to Invest in Knowledge, a podcast for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset protection. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Now, did you know that the income tax was first collected by the United States government in 1862 to help finance the Civil War? President Abraham Lincoln signed into law a revenue-raising measure to help pay for Civil War expenses. The measure created a Commissioner of Internal Revenue and the nation's first income tax. It levied a 3% tax on incomes between $600 and $10,000 and a 5% tax on incomes of more than $10,000. The federal tax code was created in 1913 and at the time just 400 pages long. It now covers more than 70,000 pages of complex rules regarding income, exemptions, and credits. So what is income tax, other than something that we all dread paying? Well, in a nutshell, governments impose income tax on money generated by businesses and individuals within their jurisdiction. By law, taxpayers in the United States must file an income tax return annually to determine their tax obligations. This tax then serves as a source of revenue for the governments, used to fund public services, pay for government obligations, and provide goods for citizens. Historically, the funds collected also help pay for government programs and services such as Social Security, national security, schools, and roads. In addition to the federal government, many states and local jurisdictions also levy income taxes. Tax collection and enforcement falls upon the Internal Revenue Service, of course the IRS, in the United States. The agency collects taxes on all forms of income such as wages, salaries, commissions, investments, and business earnings. Certain investments, like housing authority bonds, are exempt from income taxes in some cases. To calculate the amount of tax owed by any business or individual, the IRS employs a complex set of rules and regulations to determine reportable and taxable income, deductions, credits, etc. Now, as I mentioned, the United States imposed the nation's first income tax in 1862 to help finance the Civil War. After the war, the tax was repealed, but it was reinstated after passage of the Revenue Act of 1913. The same year, Form 1040 was introduced. Most countries, including the United States, employ a progressive income tax system in which higher income earners pay a higher tax rate compared to lower income individuals and families. The idea behind the progressive tax system is that those who have higher incomes can afford to pay more tax. For 2023 and 24, federal income tax rates range from 10% to 37%. It's important to note that with a progressive tax structure, there is also an effective tax rate, which is not necessarily the same as your tax bracket. So let's look at a high-income individual who falls into the highest current tax bracket of 37%. For the tax year 2024, that would be an individual earning more than $609,351. This individual's entire income is not taxed at the 37% rate. Only the income above that threshold is taxed at 37%. The rest is taxed according to the marginal tax rate in which it falls. So stick with me here. The first $11,600 is taxed at 10%. $11,601 to $47,150 is taxed at 12%, and so on and so on. You get the idea. Because of exemptions, deductions, and credits, most individuals do not pay taxes on all of their income. The IRS offers a series of income tax deductions and tax credits taxpayers can use to reduce their taxable income. But remember that there's a big difference between a deduction and a credit. A deduction can lower your taxable income, which may or may not lower your tax liability. A credit, on the other hand, directly reduces your income tax obligation on a dollar-for-dollar basis. So let me repeat that. A deduction can lower your taxable income, which may or may not lower your tax liability. A credit, on the other hand, directly reduces your income tax obligation on a dollar-for-dollar basis. The IRS offers tax deductions for healthcare expenses, investments, and certain education expenses. For example, if a taxpayer earns $100,000 in income and qualifies for $20,000 in deductions, the taxable income reduces to $80,000, the 100 minus the 20. Tax credits help reduce the amount owed. They were created primarily for middle income and lower income households and can include the child tax credit for dependent children or the American Opportunity Credit for education. However, higher net worth taxpayers may be able to take advantage of the Renewable Energy Investment Tax Credit, the Opportunity Zone tax credits, and the Low-Income Housing Tax Credit. Keep in mind that the all-important taxable income number is the amount arrived at by taking your adjusted gross income, or AGI, minus any itemized deductions or your standard deduction. Businesses also pay income taxes on their earnings. The IRS taxes income from corporations, partnerships, self-employed contractors, and small businesses. Depending on the business structure, the corporation, its owners, or shareholders report their business income and then deduct their operating and capital expenses. Generally, the difference between their business income and their operating and capital expenses is considered their taxable business income. Now, most states also levy a personal income tax, but 9 states do not. They are Alaska, Florida, New Hampshire, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Those of you living in Tennessee repealed its Hall tax, which taxed dividends and interest on January 1st, 2021. And New Hampshire phased out the tax it previously imposed on dividends and interest until January 1st, 2024, residents paid a 5% tax on any dividends and interest that they earned. Keep in mind, though, that it may not necessarily be cheap to live in a state that does not levy income taxes. This is because states often make up the lost revenue with other taxes or reduced services. For instance, Florida residents pay a 6% sales tax on goods and services, while California has the highest base sales tax rate of 7.5%, and they charge an income tax too. In my home state of New York, the state imposes a 4% tax on the purchase of goods and services, but counties and localities often add a percentage, making the most common sales tax rate 8% across the state. This is an important consideration if you are thinking about retiring to a state other than your home state. According to Intuit, a leading software company for tax filings, where you live matters. A person earning $100,000 a year in Hawaii will pay almost 50% more in state income taxes than someone who earns the same amount but lives in Indiana. Income tax, sales tax, and other obligations can also have a big impact on your cost of living. To further complicate matters, the federal and state governments continually adjust their tax systems in ways both large and small, making it really difficult to predict your tax liability from year to year. The bottom line is that all taxpayers pay federal income tax, and depending on where you live, you may have to pay state and local income taxes too. The United States has a progressive income tax system, which means that higher income earners pay a higher tax rate than those with lower incomes. But most taxpayers do not pay taxes on all of their income, thanks to exemptions and deductions. One of the services I offer high net worth retirees is proactive tax planning. We review anticipated income from all sources each year and employ strategies to help clients make the most of their hard-earned money. If this sounds like something from which you could benefit, please reach out to us. You can find more about the services we offer at www.jgigliello.com. And don't forget, we always encourage you to take part in the financial planning process to pursue a confident financial future and in turn, feel optimistic and proud about your accomplishments. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand the success of your retirement is too important to be managing yourself, and you value experienced and professional guidance, feel free to give us a call for a complimentary initial consultation. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If there's a financial planning topic you would like us to address on a future episode of Invest in Knowledge, please reach out and let us know. And thanks for listening. Make it a great day. Material for this episode was derived from an Investopedia article, What is Income Tax and How Are Different Types Calculated?, published March 14, 2024, and in the Wall Street Journal, published January 28, 2025, article titled, What's New This Tax Season That Can Save You Money? John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation.